Is Michael Saylor playing a high-stakes game of Monopoly, or has he actually discovered the ultimate infinite money glitch for the 21st century? I've been interested with how digital credit is being used to strip away Bitcoin's volatility and sell it back to the legacy world as a safe yield. But I wanted to learn more to really understand it. So in the next hour, macro strategist and MSTR expert Dan Hillary reveals why risk is the asset and why the very thing that makes a lot of people nervous, Saylor telling that he's going to sell Bitcoin, is actually one of the most bullish signals we've ever seen. This is a real deep dive into the background and plumbing of MSTR and Stretch. And I've learned a lot, and I think it will also be valuable for you. If you're enjoying my content, it would mean a lot to me if you could subscribe to the channel and like my video to support my journey. Thanks a lot. Now let's dive into this episode. Dan Hillary, welcome to Bitcoin for Millennials.
Hey, Bram. Thanks for having me.
Yeah, thanks for coming on. I thought it would be timely to talk to you, right? Like I've talked to Jeff Walton a few times about strategy, Stretch, etc. You are also very deep into this, also working with Jeff, right, with True North. So I thought it would be nice to get you on and kind of like talk through what I think a lot of people are not getting, but also I want to ask you some questions that I still have, right? Maybe just to start, because it's something that I didn't know before, and I think is very important, right? A lot of people say like, oh, well, but who is buying Stretch, right? Like who is buying these products? And I saw that you kind of argued for Bitcoin to win, to really be established in the world, right? It has to eat away at this bond market that is basically, 100 trillion that goes on in there. Why is that the case? And why does that actually establish Bitcoin as, this pristine collateral or the best collateral, however you want to define that?
Absolutely. I think that's a great place to start. Well, simply because obviously the M2 money supply is about a $20 trillion market. And for Bitcoin to serve as a encoded monetary policy asset, or digital capital is another word for that, you need to attack kind of where value resides across all markets. And in a fractional reserve banking and a debt-based monetary system, most of that value is in debt. It's in the bond market, right? A large part of that bond market is government bonds. Obviously, there's corporate bonds and different other forms of fixed income products in those markets. But Bitcoin ultimately needs to address those markets to start replacing fiat-backed credit. And so, for example, the most pristine form of fiat-backed credit is a T-bill, right? It's a government debt that trades in the open market, and stablecoins are effectively a transaction layer, an extrapolated transaction layer that is a payment mechanism for T-bills and for fiat monetary policy. Stretch is this new form of collateral, of debt, that's backed by Bitcoin's monetary policy. And we can get into some of the mechanics later, and it's a little bit technical. But the point being is I think you need to think you need to think about Stretch as a Bitcoin-backed short duration credit instrument, much like a T-bill is to the US government's monetary policy.
So I want to talk about why Bitcoin is good collateral. We'll get to that. But first, I saw you also talk about how the risk is the asset, and we are just talking about how Bitcoin is the collateral, i.e. the asset. So what does risk is the asset mean? Because all the financial advisors in the world always say, diversify, lower the risk, etc. What does selling risk mean? Like why is Saylor selling risk? Why is he talking about, I'm stripping the volatility and it's lower the risk? Like what does that even mean?
Absolutely. And I think it's important to start from the point of like, what do you own in your brokerage account or when you own a T-bill, right? And what kind of risks are there? So when I own a T-bill, it's backed by the good faith of that asset. It's backed by the good faith of the United States government. That's the collateral, our Fed's monetary policy. There's also extrapolated layers of risk there, like the brokerage could get shut down. Your bank account could be insolvent, et cetera, et cetera. There could be a run on the bank. Obviously, fractional reserve banking makes it such that your deposits aren't there, right? And so there are risks associated with owning these instruments. Now, with MSTR, with Strategy, they're acting as a de facto central bank or issuer of this Bitcoin-backed instrument, right? So if you read through the prospectus of STRC, we're specifically talking about STRC right now, it's not collateralized by the Bitcoin. It's backed by the good faith and the credit quality of MSTR, of Strategy, that owns a lot of Bitcoin. So this is a traditional way in which insurance companies structure their balance sheets. Again, like if something were to happen to Strategy, you're not directly owed the Bitcoin, but Strategy has protections to investor protections such that they have to pay out the STRC dividend. So when we say STRC is backed by Bitcoin, you can look at all the different public markets accounting functions on their balance sheet and determine how much Bitcoin they hold as a company that can be used to continually pay out the perpetual dividend on STRC based on its priority in the capital structure. And that's really how you determine the credit quality of the instrument.
So basically you're saying, just like with an insurer, right, or a bank, there's a stack of capital that, well, you either understand or not, right? Like you understand Bitcoin or not, or you understand all the land the US owns, or you understand, the balance sheet of a bank or an insurer, right? Like, for example, mortgages with a bank, the collateral are all the homes, right? So they're basically saying if all these people default, or if the bank goes bust, if the bank goes bust, we can still sell the homes. It's XYZ over collateralized, and therefore people can get their money back.
That's exactly right. And I think the most important key point to understand about STRC and these products is that it's not, so for example, like let's say I were on a fictitious MSTR balance sheet, they had one Bitcoin and that was worth $80,000, and they issued $80,000 of STRC against that one Bitcoin. If this were the case, right, that STRC would be as risky as owning the Bitcoin, and the 13% yield wouldn't be attractive. The only way to issue a outstanding liability or a preferred equity that has a stable yield, it has to be over collateralized by the Bitcoin on the balance sheet. So Strategy has to own more Bitcoin than they're issuing USD nominated values of liabilities or of preferred equity. So they have to have, generally it's about, 3-to-1. They have to own 3-to-1 Bitcoin relative to preferred equities outstanding, because that way, as Bitcoin's volatility goes up and down, up and down, up and down, the collateralization remains for those senior products. And this is important, and why this can really only be done in a seasoned public market, a seasoned issuer in a public market structure in a vehicle like that. So
what is a
Strategy?
What is a seasoned issuer?
So a seasoned issuer is someone who's been issuing securities in the public markets for a greater than a 3-year period of time. There's a bunch of different kind of requirements. You have to have a certain outstanding market cap. You have to have issued a certain amount of equity over the past few years. But Strategy right now is the only seasoned issuer in the market. Strive has not yet hit that threshold.
If something happened to you tomorrow, could your family access your Bitcoin? Not probably, not they'd figure it out, but with certainty. I've thought about this a lot. Whatever custody solution you are using, inheritance is the piece most people haven't solved yet. Billions in Bitcoin have already been lost because someone died without a plan. With OnRamp, inheritance planning is built directly into your custody setup. Your Bitcoin stays segregated and in your control, secured across independent institutions in multiple jurisdictions, insured through Lloyd's of London, and accessible to the people you choose when they need it. And it doesn't matter where in the world you or they are. You can book a free consultation to learn more at onrampbitcoin.com/Bram. That's onrampbitcoin.com/Bram. Most people stop too early with Bitcoin. They buy it, maybe move it to a wallet and think they are done. But they're not. The real questions are how you're securing it, how private your setup is, and whether you're verifying your own transactions or trusting someone else. And what happens to your Bitcoin when something happens to you? This is the layer that most people ignore, and it's the most important one. That's why I've been working with the Bitcoin Way. They help you set up self-custody properly, including privacy, cybersecurity, inheritance, and even running your own node. And they do it without ever touching your Bitcoin. They're not a custodian. They're your support team. If you're serious about this like I am, go to thebitcoinway.com/Bram, that's BRAM, to book a free call. They'll walk you through your setup, personalize everything to you, and help you get a much stronger position very quickly, whether you're a beginner or more advanced. That's thebitcoinway.com/Bram. My idea now is that Saylor is using Bitcoin. That's why he talks about Bitcoin being digital capital, right? He's using, so instead of the capital on a balance sheet of a bank, which, the fiat capital or the portfolio of real estate that has mortgages with them, right? Or, all the premiums of an insurance company, etc. He's saying, I'm doing it with Bitcoin. So conceptually, these are the same, but he's doing it with Bitcoin, which is obviously, digitally native, right? So he calls it digital capital, right? Now, there's a lot of people that say like, well, this is not, what Bitcoin is or how you should use it, etc. But capital is just pooled money, right? So he's talking about digital capital. I would say he's still talking about money, right? But then people are saying, well, this is, Bitcoin derivative, paper Bitcoin, etc., this and that. Why are Bitcoin derivatives good, and why would they be bad? Or maybe more importantly, like, how could like a poorly designed derivative market on Bitcoin potentially kind of like blow up, right? I think these are questions that people have, like, why would it be a good thing? Why would it be a bad thing?
Yeah, that's a great question. And I think specifically with these instruments, right, they're US dollar denominated fixed income products backed by Bitcoin. There's a real ratio that the companies, the issuers, have to get right. And that's the amount of these, I call them liabilities, even though they really aren't, right? A preferred equity isn't technically a liability, but for the sake of argument, let's just say it is. The ratio of these liabilities to the total capital assets, that being the Bitcoin on the balance sheet, has to be maintained in a responsible manner. Because if it's not, then the credit quality of these liabilities, of STRC, of these preferred equities is, it becomes less superior. It becomes less creditworthy. So for example, right now, strategy has 33% amplification. That's what they call amplification. And that's the ratio of the outstanding STRC, convertible debt, and other preferred equities relative to strategy's total Bitcoin holdings. For sake of argument, let's say let's say they just willy-nilly went and issued a lot more stretch tomorrow. Let's say they issued another 16 billion of stretch tomorrow. Now their amplification, or the ratio of total liabilities to capital assets, that being Bitcoin, would go closer to 50% or 60%. And in the case that Bitcoin were to fall by 50% over the course of a short period of time, now all the liabilities outstanding would be equal to the total Bitcoin on the balance sheet. And if something like that were to happen, right, this is my example of an irresponsible capital management vehicle, then there would be no over-collateralization to pay these instruments, and the instruments would trade all crazy. They would start trading down, they would start trading up based on credit quality. So again, it's that over-collateralization in these public vehicles that allow over-collateralization, meaning more Bitcoin than outstanding STRC, that allows for Bitcoin's volatility to continue, but for the holders of the preferred equity to not experience that volatility because they're insulated by extra Bitcoin in the capital structure.
Yeah. So by having this buffer is a great word, right?
Yeah, buffer is a great word.
Because they have this buffer, this is what they mean with strip the volatility, right? So it is
exactly, yep.
It is not Bitcoin, right? You can always buy Bitcoin, but the risk profile of Bitcoin, or well, risk, I don't think volatility is risk, but so I don't know if that's the word I need to use, right?
I like volatility profile. I think that's a great
way. Okay, yeah. So the volatility profile, so of Bitcoin is way different also in time frame, right? Like holding Bitcoin for a year is volatile in its own way, but it's in 5 years it is volatile in a different way. So if I'm understanding correctly, right, like when using Bitcoin to create a product like Stretch, you're saying, with this peg with 100, it basically moves around 100, right? So that is why some people say like Stretch, you can also see it as a stable coin, right? Like a stable coin is not always $1, right? Sometimes it's 96 cents or 94 and then up and down, whatever. Is that a good way to describe it then, right? Like it's just it's a different thing. It is definitely not Bitcoin, right? It's a fiat money product, but you're connecting it to Bitcoin. And I find it interesting because if we go back to the comparison with the risk of a country, right? I think, and also just companies in general, I think Jeff used in his CoffeeZilla interview the 60-year bond of Ford, right? Like Ford has a 60-year bond. I saw Austria has a 100-year bond, which is already down 40% or something like that, right? So no one will ever trade that anymore. I think this is where we should look, right? Like there are pools of capital that are actually looking for places for long duration allocation with a low volatility. Is that a good way to describe it, right? Like there is money that is looking for those places.
Absolutely. And I go as far as, I totally agree with what you're saying. And but the one thing, like you mentioned, this, Austria bond is down 40%. When you take a bond, for example, a US 10-year note, it doesn't necessitate that the principal is stable, right? Because interest rates can change, the credit quality of the issuer could change. So bonds can be quite volatile over long periods of time.
In those years, you mean, right? Like you don't know what's going to happen in the next. Yeah, exactly. So it's like you don't know what's going to happen with Ford in the next 60 years, right? It's quite. I would say it's quite risky if you do that, right? But again, different people have different risk profiles, right? So.
But just on that same point, it's like in that interim between the point at which the bond is issued and the point at which the principal is returned, plus all the coupon payments over the lifetime of the bond, the value of the bond can go up and down. It could start at 100, it could trade down to 80, it can trade up to 120, right? Like you're saying. And that can be really problematic for people trying to just protect money, save money. And that's what Stretch ultimately solves. And the way to think about this is, and everything you're saying is spot on. Specifically, like let's use U.S. government debt, right? Treasury bonds. So if you bought a 10-year Treasury bond today and the 10-year note is yielding, I think it's like 4.5%. If interest rates over the period of your hold, so you buy it for $100 and you're getting 4.5% annualized until you get the principal repaid at the end of the 10-year period of time. If interest rates, generally controlled by the Fed, were to increase, the value of your bond would go from $100 in that interim period of time to $80 or $70, because you have to discount the future cash flows of that note into the future based on inflation.
Exactly. Yeah.
With Stretch, it's amazing because it's priced based on the 30-day trailing volume-weighted average price of Stretch to be designed to trade around 100. So you don't take on interest rate risk. You don't take on principal risk in the same way you would with a fixed term bond. But the interest rate can fluctuate. For example, if the SOFR rate or the short-term funding rate were to go down to 2%, it's likely over a period of time that Stretch's annualized yield could drop from, because there'd be so much demand, from 11.5 to 11 to 10. So by holding Stretch, you're not guaranteed an interest rate, but you are, based on the credit worthiness and the execution of strategy as a management team, you are betting that the principal will stay stable. And for a lot of people, that's like a bank account. They want the stable principal and don't want to have to speculate on where interest rates will be in the future. So that's what's amazing about this product. And it has to be done in a preferred equity, with a preferred equity instrument with an ATM on it. And we could talk about that later, but it's actually a novel structure. Stretch is the only product like it in the market.
Yeah. So for millennials that listen and who hear credit market, right? A lot of people would probably think about the 2008 crash. I've talked quite a lot about this, and I wonder what you think. But like, how is a Bitcoin-backed credit system fundamentally more honest than a similar type of product or scheme in a fiat system.
Yeah, and I haven't spent too much time thinking about this, but the way I think about it in my mind is you can think of stretch as, so when a bank issues credit in the form of money, it's fractionally reserved. So the bank doesn't have the reserves to back all the outstanding liabilities. That is the circulating M2 money supply. With stretch, it's over-collateralized by the Bitcoin holdings. So you could argue that it's instead of a fractional reserve, it's an over-collateralized reserve or a fully reserved note or paper money issuance that's backed by the Bitcoin. So I think we're seeing this new form of, we're seeing this in stablecoins too, and this is a bit of a tangent, but stablecoins are an example of a fully reserved asset, right? Because they are backed by T-bills and verifiable assets held on the issuer's balance sheet. Although those assets may be impaired and losing money over time, which I would argue they are, it's not a fractional reserve. So stablecoins are a fully reserved kind of new type of banking system. And Stretch is a Bitcoin reserved, Bitcoin collateralized instrument. And the reason you can offer such high yields on something over collateralized by Bitcoin is because of Bitcoin's performance relative to the US dollar.
Yeah. And I think this is a great point because this is where kind of like the divergence, I would say, takes place, right? Because if you don't understand Bitcoin or agree on the thesis of where it's going in the future, I think this is where a lot of people actually, and I want to emphasize, I'm not a fan or a hater. I just think it's interesting because it's also new. And again, I haven't been as deep in it as you, but I'm happy to hear that I do get it up until a certain degree. What you're saying about, I think a similar thing is happening here with throwing Bitcoin in the mix, right? Like people don't understand Bitcoin and therefore they have no clue how all of this works, what we're talking about. But the interesting part is that they also have no fucking clue as to how a bank works in general, right? Or what the full faith and credit worthiness of the American government even means, or how deep, the rabbit hole of exporting inflation around the world and, IMF and all that stuff actually goes. The whole industry of financial advisors that advise you to buy, T-bills and blah, blah, blah. Like it is all part of keeping this facade up, right? And I think you're saying, stable coins are fully backed by treasuries, but then still, what are treasuries worth? We just talked about it, right?
Exactly,
they are not worth anything. Over time, you are nominally, it's a real negative rate of return eventually in purchasing power, which is the entire goal of actually deploying capital into a certain asset, right, to mitigate the debasement, right? So I think this is where a lot of people kind of glitch, because if you have the anti-Bitcoin credit product argument, do you automatically have the government fiat Ponzi argument? I don't necessarily think so, but this is the point where you actually have to understand the fiat credit Ponzi as well in order to actually have a side-by-side opinion. Does that make sense? Like, does that resonate?
No, that makes perfect sense. And really interestingly, Hal Finney actually wrote about this in a talk forum in 2010. He said, I forget the exact quote, but it's something along the lines of Bitcoin as serving as a reserve asset, a collateral asset between banks, that's settled between banks, against which banks issue their own kind of paper currency collateralized by the Bitcoin. And they'd offer different rates of returns for holders based on how over-collateralized their issuance were by the Bitcoin. That's exactly what STRC
what's
is
happening. Yeah,
it's exactly what's happening, and even more so, like we're seeing the competition between Strive and MS in strategy, right? Like STRC offers 11.5%. Strive, which has a higher leverage ratio, or they issue more SATA against their Bitcoin, has to offer a higher return, so 13%, because it's by nature a little bit riskier. And so that's exactly what Hal Finney predicted between banks. It's just happening in the public markets.
Yeah. So now I kind of want to switch to maybe a bit deeper in Stretch. Like I've called this, part jokingly, part serious. It's kind of like an infinite money glitch. If there is so much money that is, slushing around, trying to find a way to mitigate the debasement, essentially, right? So preserving of capital before potentially growing it. There is so much money. There's way more money than any general person can imagine. Apparently, right? There's there at least 100 trillion that's trying to find that place. It's just that's a crazy number, right? So there's basically like this menu of all these different types of things that you could buy. They all have their different durations, risk profile, according to how much, I would say, you understand the collateral, or if you look at the Moody's, or like at or the rating. However you judge the risk, right? You are looking for places to put that money. You talk about Stretch as a variable cost of capital. Now, I'd never heard about that, so maybe you can kind of explain why having a like fluctuating cost of money is actually a competitive advantage for this flywheel that Saylor, but also Strive, is trying to create, with the goal, again, I would say, to acquire as much of the hardest money to ever exist, the best, most pristine collateral, etc., to ever exist.
Okay. So I think the place to start is to look at your bank account. And so if you have a bank account and you want to store money, you can put it in a high yield savings account. And generally what the banks do is they loan out the money. When you deposit money into a bank, they loan it out, they get a return, and they pass through some of that yield, that return, to you in your savings account. Another way to get a return on your money without having it fluctuate up or down is to put it in a money market fund. And that money market fund will have a variable yield because it's backed by a ladder of short duration U.S. treasuries. So 1 month it may be yielding 4%, the next month it may be 3.9%. But what you can count on is your $100 being $100 over time. So this is a variable rate or variable return, but stable principal instrument. In public markets, there have been attempts to have this similar sort of product or instrument. And one of those is, so obviously we talked about how bonds, the principal fluctuates over time because of the change in the credit quality of the company or the change in interest rates between issuance and the point of repayment. There have been other instruments that have tried to stay stable that are issued by public companies. One, for example, have been preferred equities that are benchmarked to SOFR. For example, I'm a company and I issue a preferred stock and I say it's going to, if the SOFR or the short-term Fed funds rate goes down by 1%, my instrument will yield 1% less. So it'll go from being 8% yield to 7% yield. However, as the company's credit quality changes, as developments happen, as the company succeeds or fails, the market begins pricing it differently, and it's difficult for the principal to stay stable. So your $100 may go to 95 or 80 and not recover. Okay, so what's novel about STRC with regards to the public markets? Well, it's really the only instance. It's the only instance in history where there's been a security issued by a public company that has successfully maintained a stable price. And the way they've done it is with the ATM. The ATM facility is a public company's ability to issue new shares in real time. Strategy uses it to limit the price at 100. So whenever the price of STRC hits 100, they issue a lot of shares. That's sell pressure in the market, and they keep the price pinned there at 100. Now, how do they increase the price of it if it were to slip below 100, right? STRC falls to 95, for example. They have to be able to raise the dividend as a response to the market pricing the instrument. So that's the major unlock, is they change the dividend on a monthly basis for STRC based on the 30-day weighted price over the prior 30 trading days. Yeah. So for example, if STRC is below 99, they increase the price, the dividend rate, which should push the instrument up. So those two mechanisms are the two mechanisms by which they stabilize it at 100. And before STRC, there was no preferred equity in the market that had a shelf registration ATM on it, so they couldn't limit the price at that upward bound. It's completely new.
So in that previous instance, it was also more tied to the performance of the company then also, right? Like, is that correct?
Exactly. So the unlock, let me try to say it more clearly. Prior to STRC, there were preferred equities that benchmarked off the SOFR rate. So they would offer 500 basis points, which is a fancy way of saying 5% above the SOFR rate. Right now, that's about 4%.
To be attractive to get capital.
Exactly. And that's how they varied
the standard rate. Yeah, exactly. Yeah. Okay.
And they tried to stabilize the principal that way, right? Because a lot of bonds will change in price based on the change in SOFR. They're saying we'll change the yield based on the change in SOFR. But that was ultimately flawed. And so because the credit quality of the company could change. With STRC, now the yield is priced based on the price at which the market values STRC. STRC goes down, the yield goes up. I know it sounds kind of simple now we're talking about it. Like, STRC down, yield up, pushes price back up to par. That's a simple mechanism. It's never been executed in public markets before.
For my European friends that want to buy Bitcoin with ease, check out Relay. I've been a longtime fan and happy to partner up with what I think is the best Bitcoin-only platform for Europeans. They offer a super simple, beginner-friendly app with no distractions and no shitcoins. You can do a quick one-time smash buy or set up automatic purchases when you're stacking regularly. And here's the thing that matters most. Relay is 100% self-custody. Every set you hold is yours. Your keys, your coins. If you want to get started, download the app via my link below or in the description and use code BRAM, that's BRAM, at checkout to get 10% off your fees. Every Bitcoiner hits this moment. You need cash. Maybe a house deposit, an emergency, or a tax bill, and you're staring at your stack thinking, do I really want to sell this? Here's the thing, you don't have to. You can borrow against your Bitcoin instead, so there's also no taxable event and your stack can keep on stacking. This is where Firefish comes in, a peer-to-peer marketplace for Bitcoin-backed loans. And Firefish isn't a lender. They built the protocol that makes this all possible, which is exactly why they never, ever have to touch your Bitcoin. During your loan, your Bitcoin sits in an on-chain multisig secured by open source code. You can easily create a loan request with your desired amount, duration, and interest rate and share it on their marketplace at firefish.io. When you get matched and decide to accept a loan offer, you can use code BRAM to get 30% off your first loan's fees. That's firefish.io and code BRAM. Why is it so then that stretch can actually be 11%? Is that like necessary to just like kickstart the capital flow and it eventually goes down to, I don't know, 9 or 8.5, which is still way above, let's say baseline interest rate, especially toward the future, right? I think that plays into it. But also, and I don't know if that's connected, but in my mind it is, like, I wanted to ask you, like, but what if over the next 10 years, they issue, I don't know, 100 billion extra stock certificates, right? Like, would that actually matter? Like, does it matter how much outstanding units of stock there are?
Look, it's a great point. And I think there's a lot of variables here. And it's all reflected in STRC demand, right? So as long as there's demand at $100, strategy can issue more stretch. And if there's a lack of demand at $100, then strategy will increase the interest rate. And the amazing thing is it's really the market finding that equilibrium. And the higher for longer strategy is willing to keep the interest rate on stretch, the more they can issue at 100 because there will be increased demand. Right? The demand for stretch is really only a function of the creditworthiness of strategy, so that Bitcoin as collateral, and the interest rate. So, Saylor on the most recent earnings call said he'd be willing to keep the interest rate at 11.5% for a sustained period of time in order to issue more stretch. Like, for example, if the interest rate, if there was just unlimited demand for stretch, if there was, then strategy has two options to curb that demand, essentially, to limit the price at 100. And that's to continue issuing at 100 to cap the price or to lower the interest rate. And there will come a point in time where they will likely lower the interest rate. Saylor has talked about the cost of capital over 10 years being about 8% for stretch. So he's saying it will likely come down. But that's a function of them kind of selling out of Stretch, of having so much demand that they've issued so much that their balance sheet no longer has capacity for more Stretch issuance. I don't think we're anywhere close to that point yet.
Okay, so also in the earnings call, there was a lot of noise, right? That on X and wherever, Saylor mentioned, possibly selling, etc. Yeah, I told you in the beginning my idea around this, right? Like I don't think it's an issue if you have to pay Bitcoin to pay for Stretch. That sounds very Ponzi-ish, obviously. But yeah, if it makes you survive across, I don't know, a bear market or whatever, because you have a long-term thesis, right? 10, 20-year thesis, or, Saylor talked about 2042 before, right? Like as to where the value of Bitcoin is. Then, in my opinion, it doesn't really matter, but I would love to hear from you why it doesn't matter or why it does matter. Why did he even say that?
So my thinking is that the reason he said he'd be willing to sell Bitcoin is because it makes it seem to credit rating agencies and index agents, indices like the S&P 500 listing committees, that the capital gains from Bitcoin are being used to pay the Stretch dividend. By selling Bitcoin to pay dividends or having the ability to, it shows people that the dividends are being paid by capital appreciation of the assets on the balance sheet instead of by new capital in the door. Right now, strategy will continue to pay dividends with stock issuance. And they laid out quite clearly that whenever stock is trading at a premium to NAV, it's more accretive to sell the stock and use that to pay the dividends on the preferred equities. But for example, if shorts hammer the stock below 1.2 times MNAV, and that's just the scenario in which the common equity is trading very close to book value, then they could trim some Bitcoin and pay the pref divs instead of selling the equity, when it would be destructive to Bitcoin per share to sell the equity. That's just a complicated way of saying when the equity is undervalued, MSTR, it's more advantageous or beneficial to shareholders if they trim off a little bit of Bitcoin and pay the dividends. And it makes... So that's the mechanical reason for a Bitcoin per share basis. The secondary reason is the optics look a lot better when they sell a little bit of Bitcoin or have the option to pay dividends, because it comes from capital appreciation, not new raised capital.
Yeah, exactly. So there's a huge difference between the Ponzi argument and the actual mechanic, right? And also, like you're saying, it also respects the MSTR shareholders to a degree, right? Because
exactly,
it's not diluting their the shares amount. And also, I would say then he's actually using Bitcoin as capital, right? Like, isn't that the whole point, that he's using it? I would also say then it adds to distribution of said Bitcoin. I think it also helps. I had another question, obviously, around, can he get too big? Well, if he uses, because that's, I think, why he shouts it from the rooftops, like, hey guys, this is my playbook, right? Because I think the optics are bad, right? If he has 2 million Bitcoin, I don't think that would be a good thing in general, if still not enough people care about Bitcoin and there's actually, growing demand. So using Bitcoin as capital, right? Just in a classic way, like, a country could sell an airport or a harbor or, whatever a country can sell to actually pay for whatever obligation they have, right? This is, in my mind, kind of like a similar thing.
Yeah. It's, I think it's a great signal for the market.
Okay.
It's a great signal.
So if the Stretch yield is 10 to 12%, Bitcoin grows at a 25 or 50% CAGR, whatever model you want to follow, to maybe dismantle the Ponzi part, who's actually paying for the yield? Is it just like a transfer of wealth from people that have dollars to the holder of Bitcoin? is it an arbitrage on kind of like fiat money ignorance? I heard a great analogy. Someone said, my editor, Gary, he said, it's like Saylor is selling sand in the desert. And people, because they see sand around them, they think sand is valuable or something. But he's buying water, right? Like he's selling sand and he's buying water or something like that. Is it just an arbitrage on ignorance, or is that too simple to kind of like classify this? Because if you understand Bitcoin, right, like you have to understand Bitcoin to a degree to get Stretch, or maybe you think not, right? But like, why wouldn't you buy the Bitcoin? Like, I'd be interested to hear your thoughts on that.
Yeah, I think it's what we talked about earlier. It's return profile, right? Like different people have different necessities for return profile. Like for short-term capital, if I need to pay taxes with, if I have 100 grand, I need to pay taxes with in 6 months' time. I can't stomach a 50% drawdown with that capital over that period of time. Obviously, Bitcoin has had historical volatility. So you need shorter duration capital that you can count on the principal being returned. And that's the benefit of Stretch. To that point, Bitcoin's the raw capital. It does what it does. It goes up, it goes down, generally over long periods of time. People, myself included, are betting that it outperforms the interest rate on the Stretch dividend. So I think that's part of this conversation that was really missed in the CoffeeZilla interview as well, is for Stretch to work, you have to have someone willing to take the bet that Bitcoin outperforms the interest rate paid to Stretch holders. And that ultimately is the MSTR shareholder, right? Anyone who holds MSTR now benefits from the leverage created in the capital structure. The leverage being, as an MSTR shareholder, you have a claim over this Bitcoin that you're then paying. So as an MSTR shareholder, you essentially have a claim over 150% Bitcoin, but that extra 50% Bitcoin you have a claim over, you're paying 11.5% annualized to the Stretch holders to keep that leverage. So that's kind of how the capital structure is created. And so long as there's people willing to take that bet, the leverage or amplified Bitcoin bet, you can create something like Stretch for holders who aren't betting. I mean, arguably, as a Stretch holder, you're betting in whatever period of time you decide to hold the instrument that Bitcoin won't outperform it, or you just want that return on a predictable basis with zero volatility. So that's kind of the target market. Yeah.
So here's one thing I would push back on, right? I think with a stock having a claim on, XYZ Bitcoin of that company, I don't want to say it's not correct, but there is no claim, right? It's more like you have a share in a company that has a machine to acquire the hardest capital in the world that has a certain value, and therefore, then you kind of go back to business model, or your idea of how well they can optimize their business model of acquiring said capital, right? And that is, I would say, in general, why you buy a stock, right? Like if you have Apple stock, you don't have a claim on the amount of iPhones in the warehouse, or if you have a Boeing stock, you don't have a claim on the planes still to be developed, right? It's more about betting on the fact that they can actually perform their business model better over time, and that is what I wanted to say to you. Like that is also why they call it income, right, or a return, right? Like a Bitcoin per share, right? It's kind of, for me at least, a metric that kind of shows how well they are executing their business model. Would you agree?
Yeah. You're totally right. Obviously, no common shareholder has a claim over the Bitcoin, but you can argue in the case of liquidation of the company, or if the company ceased to exist, this would be how much Bitcoin each shareholder across the capital stack was paid out. That's the way you can think about it, but and it's never that clean in bankruptcy proceedings in the United States. So you don't own the Bitcoin, that's for sure.
Yeah. Well, but it's definitely cleaner than some electronics manufacturer that goes bust, right? And that, I think, again, goes back to just the the pristine collateral idea of Bitcoin is the fact that any company attempting something with Bitcoin actually just by definition has a different risk profile than, planes or whatever types of products a company is using as their capital stack, just because you can liquidate it so easily. Okay, yes, so you believe Bitcoin will eventually eat this, 100 trillion global bond market. I'm more convinced, slowly also, because I just didn't understand from the beginning, but just having the understanding of there's so much money that's trying to find, a place. We talked kind of about, also before, and I think you also talk about it, right? 60-40 is kind of dead, right? Like nominal returns are dumb if you lose the purchasing power, etc. What is the big idea here that, TradFi Wall Street is just totally missing? This, transition from fiat type bonds to Bitcoin-backed credit bonds, however you want to define that, because it sounds, well, maybe it sounds too good to be true, but it also sounds like it's working, or it looks like it's working.
Yeah, I mean, I think it's going to take a long time to be long time to be adopted, and that's obviously the opportunity that presents itself for anyone who holds Bitcoin. But it's not. I don't think it's going to be for years until there's a rating on some of these preferred products, and until they're trading in the market for 3 years plus, most institutional investors are unable to allocate to something like Stretch or any strategy's preferred equities. So there's a lot of runway for Bitcoin accumulation over time, but I do think it will shape kind of the. Like you can take it to an extreme. Like, I have in the past talked about how STRC is redefining the cost of capital across all public markets, right? Like the S&P historically returns 9%, 10% with dividends reinvested. And, if Stretch is turning 11.5% on a return of capital basis, tax deferred, predictably on what now will be a 2-week time frame, because dividends will be paid out semi-monthly. Like it's hard, it's arguably Stretch is better than the S&P. You could argue Stretch is better than money market. You could argue Stretch is better than private equity. You could argue Stretch is better than venture capital, et cetera, et cetera, et cetera. So you can take it to the extreme. But these things move really slowly, and, big money moves very, very slowly. So I think this is definitely a marathon of proving out Bitcoin-backed returns. And I don't think Stretch will be the only. I think Stretch will be the winner long-term, or the most dominant player. But SETA will likely take part of market share. And then also, we haven't even talked about this yet, and I don't want to derail the conversation, but I think there's going to be short duration Bitcoin-backed credit that is very successful as well. So actual collateralized notes, something like Stretch, but it's actually collateralized by someone's Bitcoin that pays a lower yield, because in the case of, because the Bitcoin is direct collateral for the instrument. So we can talk about that later.
Let's talk about that, definitely, because that would actually eat even into short-term T-bills and money market fund and stuff like that, right? Yeah. So maybe let's go there after this question, because it kind of ties into what you just said. So if Bitcoin actually becomes this global hurdle rate, right, either directly or powering a product like Stretch, right? You just alluded to, that's better than S&P, that's better than, whatever. And all these things that you mentioned, which looks like it, right? At least percentage-wise. What happens to all the companies, right? I also kind of feel that the Stretch product really is this wedge in the slushing around of fiat money in the I always just say the Ponzi scheme, right? Just the whole thing, propping up the S&P, propping up the stocks, right? Propping up real estate, all that stuff. It's just looking for different places again, right? I feel like Stretch is kind of a wedge, and it's also because what we talked about, it has, arguably, and I would say verifiably better backing, because it is Bitcoin, right? Like Bitcoin is better as collateral than real estate, is better as collateral than Apple's inventory, is better than collateral as, the ability of the US to pay back its debt, right? So what happens? What happens if this is really a wedge and Bitcoin is a global hurdle, right? Like, what happens to all the companies? What happens to these classic products? What happens to pension funds, insurers, whatever? Like all these huge capital allocators that are, in the fiat money circle jerk, slushing it all around.
Yeah, it's a good question. And I mean, ultimately, if Stretch is successful at beating the returns of traditional capital vehicles over 1 year, 2 years, 3 years, 4 years, 5 years, it should continue to siphon money away from those instruments, demonetize those different investments, and power up Bitcoin, the Bitcoin network, and sustain a long-term growth rate in Bitcoin above all of those other assets. That's kind of the thesis. Another aspect that's massively important, which will drive inflows into Stretch over other alternative investments, is simply the liquidity. And we've talked about that a lot in some of our True North calls. Is Bitcoin's really the only 24/7 liquid, globally traded asset in the world, and now you're using it to back a preferred stock that's 1,000 times more liquid than any other preferred stock in the market. And when you look at some of the problems with private credit, venture capital, and private equity, especially with some of the redemptions that have been halted over the past few months, investors are looking for an alternative. So alternative investments are private equity, venture capital, and private credit, generally speaking. And while they're illiquid, they tend to return higher than the traditional S&P or index funds. Now you have something like Stretch, which is liquid and returns higher than the S&P. And that liquidity, there is a premium on liquidity. So if you can get higher returns and higher liquidity in Stretch than you can in private credit, there's going to be tough to make that case for private credit over a long period of time. And I think that's what we'll see, the demonetization of alternative investments and the monetization of the Bitcoin network over time.
And so let's talk about these shorter duration products. Do you think that would be something that Strategy would issue, or is that actually kind of like a market opportunity that opens up, perhaps even for these incumbents that, turn their fiat capital into Bitcoin capital and then start serving, a different part of the market, probably, right, with shorter duration type products?
Yeah, and I think it's a huge, huge question because I don't know what the market's going to do. It all hinges on what tokenization looks like in the future. I don't know. So obviously stablecoins are a $320 billion market growing 40% year over year. Most of that volume is on Ethereum. Bitcoin is the largest capital network and it will be the dominant capital network moving forward. Obviously that takes place on the Bitcoin blockchain. And then we have the public equities markets, which trade on different exchanges like the NASDAQ. And those are being tokenized and traded 24/7 in the near future. So I don't know where the majority of equities trading, in all of crypto are just unregulated securities. So, I consider that part of the securities market in the future. So I don't know where the securities market will trade. But the thing with Stretch that I think could be not improved upon, but someone may be looking for is a Bitcoin collateralized short-term note that has no counterparty risk. And so if you can program the short-term note to be collateralized by the Bitcoin, you can offer a yield that's lower than that of Stretch because someone may look at it as being less risky. And I think there's potentially, a world for that. Maybe it's on the NASDAQ. Maybe, the NASDAQ in whatever 24/7 trading looks like on the NASDAQ, you can lock up a Bitcoin and issue a short-term note against it. But I think there's potentially a market where there's no third party involved in the issuance of short-term credit against Bitcoin.
It's interesting because I think this also kind of ushers in the transition to Bitcoin as a unit of account, right? I think
Definitely,
especially for Strategy, what's it called, like the fair value accounting, and stuff like that. Just the fact that they report as Bitcoin per share earnings, etc., is kind of, I think, a little start to that. I saw you modeled like Nvidia and Apple, etc., in Bitcoin terms. I share this a lot with people, right? Or like put the Nasdaq in M2, or like put the Nasdaq in USD and then put it in M2, right? And then like in M2, it's higher or it's lower today than at the .com bubble, which is, arguably, factually wrong, right? In terms of tech value. Then when you do Bitcoin, it's even worse, right? Like it's like all-time low. When did you start thinking about Bitcoin as a unit of account in that way? Is it also a way to kind of like view everything we've talked about in a different light, right? Like, is it easier to see what's happening when you put on the Bitcoin glasses and use that unit of account versus just the fiat way?
I mean, I think I don't know when Bitcoin will be used as a unit of account. I've been doing it. For me, it just came naturally with index funds. Like I believe the best way to invest in equities markets was to invest via indices. And I've always believed Bitcoin's kind of an index for global productivity, which is effectively the purpose of money. And that's why I do believe that, you can use Bitcoin as a unit of account for your assets.
It's all good. Do you think like these companies like Nvidia or Apple, like would they be able to even start their own like digital credit type instruments? Like, do you think there will be attempts to kind of combat the siphoning away of for example, the automatic capital, right, that goes into the S&P 500, Mag 7, etc. Like, do you think that can be a thing? Is that a threat, or wouldn't they even be able to do it without Bitcoin, right? Like, is this kind of a moment where it also shows like you cannot really do it without Bitcoin?
Yeah, is it a threat, and will they potentially create digital credit and use Bitcoin as a unit of account? I think it's pretty complicated because people look for historical comparisons for equities markets, and if you really look at equities markets today, I mean, there's obviously massive concentration, reminiscent of that of the Nifty 50 in the late 50s, but with the Mag 7 now deploying most of their free cash flow, not into stock buybacks, but into capital expenditures related to AI, obviously the broader market are looking for places to, markets deploy fiat into assets that they believe will be more productive than fiat. And right now that's data centers and AI CapEx spend. Those will probably be massively, there will be winners in those markets and there will be losers. It's the idea of risk. What is risk? And I think people misallocate towards risk, specifically large corporations. And Bitcoin is certainty amidst uncertainty in public markets. And, I think over a long period of time, this is the reason why it'll be difficult to beat Bitcoin's hurdle rate and why more and more capital will be sucked into the certainty that is Bitcoin relative to the uncertainty in public markets and disruption that occurs. But that's not to say there aren't going to be, I believe there's going to be lots of success in public markets and equities. There will be equities that have compound annual growth rates of return because of AI that outpace any equity in history.
Yeah, exactly. I love that answer because, but it will have a different risk, right? Maybe that's good.
Yes,
that's good to add, right? And also, I've talked a lot about, is Bitcoin risk on? Is it risk off? Like fundamentally, characteristically, right? I think it is extremely risk off.
Yes.
But the market trades in a different way. But you just said something that made me think, well, Bitcoin is good in bad times and in good times. Right, like it is a superior savings vehicle, just as a way to park capital at least over X amount of time, depending on your risk profile, right? So whether that's 2 years or 5 years or 10, but it's also a totally separate, fundamentally very stable.
Value proposition
again. Yeah, right. Exactly. So in times of turmoil or chaos or whatever, right? You can actually exit the let's say, the TradFi system to just park your money in Bitcoin. And we are already seeing that people are doing that, right? Like whenever Bitcoin goes down on the weekend, there's going to be a rough Monday on the stock market, just because big capital allocators are already using Bitcoin as their account, right? Their liquidity account, because that's the only thing that they can actually access on the weekend. So I'm personally very bullish on that. It's just interesting to see that it's already used like that. Although obviously the price goes down when they sell in the weekend, but it's interesting to see that is already happening. So yeah, maybe some like 3 short questions to wrap it up. Talking about all of this, looking at what you're researching, what makes you the most bullish on this role of Bitcoin that's evolving in the US? We have Clarity Act coming, but also globally, let's say over the next decade, 2 decades, however far your outlook is. What makes you bullish?
It's simply returns generated by Bitcoin as collateral, Bitcoin as a capital asset with low volatility, so STRC, digital credit. I actually don't like that term that much, but anything that taps into traditional fiat markets that's powered by Bitcoin, I think is the killer application of Bitcoin. It is a killer application of Bitcoin because Bitcoin is it's encoded monetary policy, and which should theoretically outperform monetary debasement significantly, especially along its adoption curve. And we're seeing that play out in real time. And the way to funnel more and more capital into that vehicle, into Bitcoin, is to offer it in a digestible format for the biggest money managers around the world. Stretch is the first time we've seen an instrument that's actually digestible by money managers, people who have mandates to be very low volatility. Most hedge funds, most institutions cannot stomach Bitcoin's volatility and won't be able to for 20 years. In the interim, Stretch is a product that solves their problems, powered by Bitcoin, and I think there's nothing like it.
So what do you think is the end game of Saylor? Is that like, can a company become the central bank of Bitcoin? Some people say, the U.S. government will buy a share, like they bought a share in Intel. Like, how do you see that progress? Because I can imagine that if he gets too big, maybe not in Bitcoin, well, maybe in Bitcoin terms, maybe not, but just in the amount of capital that he can attract, and therefore, by the way, obviously he grows the Bitcoin stack and so on, right? Where does that end? Like, what's the goal? What does that look like?
Yeah, I'm pretty much a simpleton when it comes to this. Like, he stated it briefly that his goal is to drive Bitcoin to 1 million and then 10 million, and he will. I believe he will. All of this hinges on performance. I know a lot of Bitcoiners don't like to talk about it at the end of the day, but digital credit is this idea that Bitcoin's superior monetary properties support its outperformance of traditional fiat-based assets. And so by raising more and more capital with Stretch and with MSTR and continually building his Bitcoin stack, building the balance sheet, he's sequestering Bitcoin that will never move, that terminally pushes the price of Bitcoin higher in the long term. So I think every single Bitcoiner should be cheering what he's doing because he's working for Bitcoin. Ultimately, he's working for Bitcoin.
So it's like the end of a vacuum that keeps on getting bigger, kind of. Like
if he takes 15% of the Bitcoin supply, Bitcoin, I think people forget that the price will move aggressively in the direction upwards, and once it does, I mean, people will realize that he's bought and secured and won't be selling the majority of his capital stack. Yeah.
Okay, I have an extra question. How long until people actually take notice? In other countries, like other countries taking notice, right? Like, could you have sovereign bonds backed by Bitcoin, right? Like this whole Bitcoin bonds idea. I mean, there has to be a point where someone thinks, okay, this is a bit too much. Like, this is a bit too much for Saylor, because I can also imagine they can get capital from anywhere in the world, right? I think there's a Stretch equivalent in euro denominated, for example, right? So, I don't know. Like, what do you think? Like, I'm thinking about this just in Bitcoin terms for the last 5 years, right? Like, when is everyone going to wake up about Bitcoin? But it feels like this is a bigger threat to TradFi type products and stuff like that than spot Bitcoin?
Yeah, I mean, tech tends to centralize. Technology and financial products tend to centralize around one or two dominant players. So I actually think Stretch is one of the final incarnations of this short duration Bitcoin credit instrument. And its continued existence will just be adopted in structured products that are brought around the world. So, the liquidity is so important on these instruments, so you can trade in and out of them with big size. Stretch is the only one if you want to buy $10 million of strike, you really couldn't do it without moving the price. Stretch, you can do it in a blink of an eye. That liquidity will, you want an instrument with that kind of liquidity, it centralizes around Stretch. Then you can create a product, an ETF, for example, that has a FX swap of USD to Euro and send that over to Europe. Or you do JPY USD FX swap and sell that product in Japan. And so I think Stretch has now become, much like Bitcoin is the foundation for these products that offer high return like Stretch in the public markets. There's plenty of financial infrastructure, even in the stablecoin markets, to package up Stretch and ship it around the world. And so I think all the liquidity will concentrate around Stretch. And I actually don't think there's that much base layer financial engineering that's left to be done with regards to those products.
It's actually pretty interesting, right? Like stable coins buy treasuries, and there's that flywheel. You can have Bitcoin, Stretch, maybe also stable coins, right? That just have Stretch, right?
Exactly.
Yeah, exactly.
I think it's a massive
target. It's the layeredness, basically, that you're seeing. All right. The last question, and I ask everyone the same question, which is, what is a core belief you will never let go of?
Core belief I'll never let go of. Purpose of life is to gain freedom and then find your purpose once you've established freedom.
Awesome, man. Well, thank you so much for this deep dive. I thought it was very interesting and very helpful, and I hope the people listening found that too. So, yeah, man, let's stay in touch and see how this goes. Thanks.
Amazing. Thanks, Bram. Great question.
I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, if you want to help me shine a light on the message of Bitcoin, please like this video and subscribe to stay connected. I hope to see you for our next episode. Bye.